I think the transition to net zero is quite interesting with respect to what has happened to commodity prices already. Because if we look at what has happened to commodity prices with them rising, it makes the relative attractiveness of alternatives that much more attractive. And so consequently, it will hasten the investment into alternatives as we move forward. But there's another aspect which is really quite interesting, and that is be very, very careful about assuming that we should stop the production of fossil fuels overnight. I know that's an impossibility, but be very careful about too fast a transition whilst alternatives are not available. Because what happens then is we see the price of commodity prices rising, as we have done with the oil price in the first half of this year. And when that occurs, that has a very meaningful social implication, in as much as if we look at those who are less well off around the world, a greater proportion of their income is spent on energy, on heating, on food, and these are the people who are worst affected by these rapid price movements. So yes, it may be right to have that transition to alternatives, but let's ensure that we do that over a period of time which is managed so it minimizes the negative social impact of these price changes. If we look at asset allocation as we move forward from here, I think it's very important to look at what is discounted in markets by the poor performance over the first half of this year. And we would look at bond yields and say, well, maybe we're around the peak in terms of bond yields, and they can come down from here given the expectation of lower or less strong growth in terms of economic activity in the second half of 2022. So there could be some attractive opportunities there. If we look at credit, though, we would remain more favourably positioned towards the higher quality credit rather than the lower quality credit, partly because of leverage, partly by nature of the fact that we're going to see an economic slowdown, and we would expect the higher quality credit to outperform in such an environment. Within equities, also, we would look at some of the sell-off, particularly in some of these quality names, where they have been adversely affected by the discount rate rising. We would look at some of those areas. If you can find pricing power in this environment, if you can find sustainably high earnings or returns within companies, we believe those types of companies are going to produce attractive returns as we move forward. Because in an environment where we see pressure on economic activity, if you can show resilience, that will be rewarded. If we look at companies and how they're faring at the moment, it's fair to say that in aggregate, profitability has held up really well. But we would say be careful about that because we're likely to see pressure on profits as we move forward. One of the things which I think is really important is that as we've gone through the pandemic, spending patterns have changed. We've seen a lot of spending on goods. We've seen less spending on services. We've seen less spending on experiences. As we emerge from the pandemic, we will see a rotation here into some of those areas where we've seen less demand over the past couple of years. And so it's going to be really important to identify that, but also in terms of companies that can satisfy that demand from the consumer as we move forward. Because it has been difficult to source employees, to source labour, and we need to ensure that we're able to do that in order to satisfy the demand of customers as we move forward. We would look at the technology sector and say, look, there are those companies where they're not making profits at the moment, they're not generating cash. And certainly a year ago, some of their valuations were pretty elevated. We would say be careful of these companies unless you have real visibility in terms of that cash flow generation and in terms of that returns to shareholders. However, there is another area of technology where huge amounts of cash is being generated. Some of those largest technology companies around the world, and they have been impacted by the sell-off across equities more generally. And we think that that is an area where there's some particularly attractive opportunities as we move forward.